All right, everybody, welcome to the Sherman Show, the first one post-Labor Day. Today is Thursday, September 7th, 2023, and we have a special guest with us today. Lau, have we ever not had a special guest?
I think it's always a special guest.
Okay, well, if you didn't notice, I'm Jeff Sherman. I'm here with my co-host, Sam Lau.
Hey.
And Sam, we have a special guest today. Do you want to know who it is?
Please.
All right. We have none other than Joe Mallen. Joe, he is the Chief Executive Officer at Modelist. I wonder what they do over at Modelist, Sam. It's a platform committed to constructing personalized model portfolios tailored to the needs of each individual financial advisor and their clients. So, Joe, welcome to the show.
Hey, thanks for having me.
Yeah. And Joe, I know you in from a former role. So why don't you kind of guide us through the guide path? What made you start your own firm here at Modelist, what your objective is too, and kind of what got you on the path to creating model portfolio solutions for clients?
Yeah, so I started in the industry back in the early 2000s, working for a large RIA that had, a fund of hedge funds, fund of private equity funds, really doing a lot of due diligence on those type of products, but evolved more into a quant role. So I did a quant master's at London Business School, and then went from there to work on the quant desk at Columbia Threadneedle, and managed a series of large portfolios, a hedge fund. As an analyst on the team, really kind of learning techniques, and had a great group of guys that I worked with there. Left there and became the CIO of a Tamps platform called Sawtooth, recently acquired by a firm called Simplicity. And from that role, I evolved into Helios Quantitative Research. So I was there for about 7 years, up until just a few months ago now. And just recently, like you mentioned, I launched a firm called Modelist. And the goal really here is to, kind of carve a new niche in the industry. And I like to describe it as the intersection of the values of direct indexing, model portfolios, and AI. And I hate saying that last one in today's world, because I think it's a buzzword thrown around everywhere, but it is important to what we're trying to build in terms of scale and efficiency internally at the business.
So you're not going to you're abandoning your plan to launch with blockchain. You're going just directly to AI.
Exactly. I did reserve Modelist.ai. I'm not using it, but I took it because I thought someday that might be of value. But no, I'm not trying to have AI as part of the forefront, and I'm sure it's something we'll talk about. But it's created so much efficiency in starting a business. It really has. And it's not so much how a lot of people use it in terms of, writing a blog or a research report or anything like that. It's more, and I haven't gotten into the detail yet, but what we're trying to do at Modelist is provide a lot of investment methods to advisors that they can cobble together and kind of build their own series of model portfolios. And okay.
Oh, no, I was just going to say with that, too, maybe before you kind of start to describe some of this, maybe you can explain to our listeners and our viewers, some people are watching this on the YouTube. It's youtube.com/DoubleLine Capital. But, some of them listen as well. But maybe we can go through and talk about what is a model portfolio? What does it mean to do that? Because we hear this a lot in the industry. It's a kind of in the lexicon. But what does it mean to be a model portfolio strategist? What is it?
Yeah, it's meant a lot of things over the years, and I think it's grown in popularity in terms of the term. But to me, it's how most, call it RIAs or independent financial advisors, operate the investment portfolios for their clients. And this means, internally, whether they're trading it or using a third-party platform, they set a series of model portfolios that align with their clientele, their risk tolerance, and their unique attributes such as wanting ESG, tax efficient, et cetera. So many advisors have built their own. They hire their own internal staff. They just do it themselves if they're a really small shop, and they'll do the research on the funds they want to use, and they'll build a model. There's third-party strategists out there that you can get access to. You go directly to them. They'll give you a model. And then there's the fund manufacturers. So they've really gotten into this game over the past handful of years, where rather than just selling their individual product lineup, they build a model portfolio around that product lineup. And I think it's that evolution that's really important, because I think the wholesalers at asset managers started to realize that the access point for most financial advisors is a model. It's not necessarily the fund itself. And that's where I think that's become such a large part of, say, BlackRock's business, is we'll give away the IP of the model because they're investing in our underlying fund, and that's where we get paid.
Okay. And so you use the acronym TAMP. Maybe you can define that and then say how you think the evolution has worked, because you're talking about an evolution, right? From the TAMP to what you're describing now on the model side.
Yeah, so TAMP, turnkey asset management platform. There's many providers out there, the Orions, the GeoWealth, the SmartX, and loosely, it's a one-stop solution for financial advisors to get access to, say, CRM technology, billing, reporting, proposals. And, depending on the platform, it can be a little bit of, cobble it together, or it can be a silver bullet, one size solution. A big component of a lot of these and how they make a lot of their money is in access to investments or access to investment managers. So whereas many people use a TAMP, that advisor I spoke about may use a TAMP to do their own execution of their own strategies, their own trading, many look to what's called a model manager lineup. So this could be a series of third-party model strategists that provide their models or their stock portfolio to the TAMP to execute on their behalf. And it's a cool concept. If I'm an advisor, I can get access to some of the best strategists available in the world. I can allocate 10% to XYZ manager, 20% to another manager, and build together, build my own custom model of various models that are provided on this TAMP platform.
Okay, that makes a lot of sense to me too. And so, I used to think of the turnkey asset management platform as one where, the advisor doesn't really spend as much time on creating the model or trying to think about asset allocation advice. They're giving that as the investment platform. They're outsourcing some of that. And then they're providing the other services that go along with advisory, like whether it's tax planning, estate planning, setting goals, and really helping people achieve the process. So I always thought this was more of a, an advisor that really wants to focus on the other parts of the business and kind of outsource some of that investment side. So that's rightly or wrongly. But now let's blend this all back together, right? You've now started your own shop, Modelist. What differentiates, or what is your goal of differentiating Modelist from the things we described today?
Yeah, you just brought up a great point that most advisors that are good and they want to grow, they don't do a lot of investment management work. It's a core part of what they offer, but it's rarely their core competency. So there's benefit to outsourcing. You remove your brand a little bit. You say, hey, I'm more of a quarterback in terms of your investment portfolio, and I'm outsourcing it to these various investment managers. You probably recognize the name. They're a bunch of smart people. In order to do that, though, you lose a lot of things. You give up branding of your organization, you give up control, and you pay typically a much higher fee to get access to an aggregate of third-party investment managers. What I'm trying to do at Modelist is take the benefits of that third-party outsourcing, but put it into the advisor's control under their brand. So we've built a series of underlying investment methods, and this is what a lot of third-party strategists are doing, whether it's trend following, momentum, relative strength, duration management, credit management, just a lot of techniques that are often done within a fund-based portfolio. Doing the research, giving away that IP to investment advisors, letting them, with our help, construct their own model portfolio. And the benefits are now they get to retain the name brand, they get to have control, they get the customization, and we're just doing a kind of all the intellectual dirty work and then the execution of the strategies. So we can trim off a lot of fat in terms of fees, and we give that advisor really a selling point to their practice and to their clients that they've built something custom for their clientele. They're not outsourcing it.
So in addition to offering some portfolio solutions from the model side, in terms of creating or coming up with theses, in terms of how an advisor might want to be positioned for the coming environment, is there something that you offer through Modelist in terms of research or other resources within that standpoint?
100%. And we call everything we do evidence-based investing. So it's really this notion that you think of a concept, you test the theory, you prove it, and then you execute it like a robot over and over and over again. So you mentioned, topics right now that people are concerned about. We're probably on the latter legs of this, but like inflation. We have a method for how to invest with inflation expectations. For example, you look at the Philly Fed 12-month inflation expectation, and if it's above long-term average, we'll consider us in a inflationary environment. If it's below, we'll consider us not in an inflationary environment. Very simple concept. And when you're above, you own this basket of funds. When you're below, you own this basket of funds, tips, commodities, utilities, energy, and then, IT, emerging markets, et cetera. And when you test this, it's like, well, this thesis kind of plays out. And this is a lot of what we would do just as being like in an investment committee at an RIA. It's like, what are we looking at right now? Where do we want to be invested? But if I was really shooting from the hip, we think if we can digest that concept into a proven, back-tested way of looking at that concept and introduce it to a model, you can build that theme within that model for the advisor. So it's not about necessarily trying to jump between these themes, but you can build a combination of some long-term factor-based type concepts within your model, but then we can introduce things for, a select period of time that may be more applicable to the current environment.
So, and then from there,
go ahead. Good, Sam.
Yeah, I was going to follow up with that, and from there, in terms of the actual investable universe, once you come up with a model portfolio, you might think about various asset classes and weightings and allocations to that. But within that ecosystem, what role do asset managers play? And thinking about it from an active versus passive, side, or even from traditional assets versus alternative assets, private versus public, credit and equity, and even vehicle type, mutual funds, ETFs, or other vehicles within that sphere.
Great question. Not a lot on the private side. We're focusing mostly on tradable securities. A portfolio can look as simple as 4 tickers, call it a US, an international bond, and a commodity fund, or it can be as complex as 25 tickers. We can get sectors and countries and things included in the model. So it tends to lean towards low-cost ETFs. If you think about this whole narrative of giving your client a really powerful model at really low cost, we can gain exposure if we're doing a lot of the value proposition within the model design. But that being said, we do use active managers in asset classes where there's just not any available efficiency to trade in it. Like, for example, large cap blend, rarely will you ever see me promote an active manager. Maybe something with like a buffered exposure or some sort of derivative exposure. But in the core bond space, yeah, we do see a lot of active managers. The cost is low, especially when weighted in a larger portfolio. It's not that expensive. So we can range from purely passive to incredibly active. Most folks, I think, are somewhere in between. And we'll do a lot of the fund picking and the fund research and have recommendations for advisors, but they're able to actually use their own fund selections within that asset class if they so choose.
So as you think through it and you think about your models too, do you think of this as kind of you mentioned the 4 ticker example. I'll call it the simple execution model. You have the more elaboration or more elaborate versions. But as you kind of build this together too, do you think of it as like a hub and spoke kind of approach? And what I mean is that, or like a core satellite is a phrase that people use, where you have these kind of anchor allocations and then, maybe put some thematic models around that as well. Like you get the illustration of like inflation. Someone may want to be betting on, recessionary environment, which has a certain type of model. So how do you kind of envision people doing? I know you want to be everything to everyone, right? But kind of what is like that kind of core recommendation, how you would give that kind of initial advice to your potential clients?
Candidly, that's probably the most difficult part of what we're doing, where you have this library of really cool techniques. And at first, conversation, many advisors are, well, why don't you just do it all? Well, I can't, because that's just overwhelming, and you end up with so many different allocations. Or you just pick for me. So we do a front-end process. We have a questionnaire to try to understand what's important to that advisor. This is what I've learned, in my past handful of years. 90% of advisors would come to us at a research firm and go, you pick, you're the experts. The more you got to know them, it was the opposite. 90% had a bias, had an opinion. And it could be something as little as like, I've always promoted dividend yield to my clients before, and I don't want to lose that story. Okay, let's maintain that. Or I'm okay with massive tracking error as long as I can explain it. The opposite's mostly true, though. I'm not okay with tracking error. I look at a back test. I love the excess return, but I'm not okay with that experience. So to answer your question, we profile and spend time with the advisor via a questionnaire to try to understand what is important to them. How many different models do you want to operate? What different versions? A California advisor may want a lot of ESG, where someone in the South, I find, want more biblical portfolios. Maybe that's way overgeneralizing and stereotyping, but that's the type of advisor we see. They're all different. So it's hard to say this is the starting point of what we have to offer, and then we can tweak it. We're trying to build upon a story with them. But that one story is rooted in evidence-based investing. So it's kind of like the core of everything we do in terms of our research reports, our content, our collateral is all built upon, robotic type investing based upon what the data says, and taking emotion completely out of the equation.
Well, you mentioned the California-based investor having a bias to potentially to ESG. I'm introduce you to Sam Lau, who during the pandemic was trying to figure out how to store the negative price of crude oil in his swimming pool. So I don't know if that was very ESG friendly at the time.
Must have offended you. But I apologize.
but Sam was definitely looking to capitalize on a negative dollar price on crude oil here in the U.S. So and then I totally remember when you see it quoted, those are for 42 gallons, of oil at a time. So I don't think it's as profitable as you think on each of those futures contracts. But needless to say, there's always a market for everyone. Just real quick on that kind of same concept too, as you're thinking through this, and you're talking to you when you say that a lot come in with their inherent biases. So are you thinking as like the first way of people using your firm Modelist is for some of those ancillary things, right? Like, hey, there's some hole in your portfolio that, okay, so given your framework, you might like dividend-based investing, but here's what we see, things that go well with that. So is that kind of part of how you're thinking about trying to, I always think of portfolio management as like plugging holes in the portfolio and trying to find out where those air pockets are, right? So is that how you're thinking about it? Or are you looking for people who, are kind of starting from scratch and just say, hey, I want to be an advisor, but I don't want the burden of asset allocation? So
it's more the latter. It's really trying to build a holistic solution across their business for them. What types of models do they need? Where can we meet you with what you've been doing? I think the former you described, I see potential there, but not quite as much. And that might be, hey, we've got our core portfolios. We're happy with them. We're simple. We don't want to pay anybody to give me an asset allocation model, but you got some cool stuff there. Can you give it to us that we can sleeve and maybe make a satellite, component of our model? Sure, we'll have those conversations. But I think to get the most benefit, it's really the whole model portfolio solution and getting an advisor to say, let me outsource this to you guys. I don't have this expertise. If you're going to do the work for some of my clients, you should do it for all of them. And, we'll absorb your content, your way of thinking about the world, the kind of proactive communication on what models are doing, and, regurgitate that to our clients.
Okay, I heard another phrase too that Sam and I have run across for many years, and used the phrase evidence-based investing. And so could you maybe walk us through what that means? And I hear that, I think of back testing, again, you use that phrase as well. There's been criticism of some managers that they've never seen a T-stat they don't like, right? That if it works in the data. But in general, what is evidence-based investing from your perspective?
It's a fair critique. I mean, it could be window dressing for back testing. I mean, I think there is importance to back testing a concept if you use it the right way. And I mean, if you think of an idea like, economic growth, like look at a leading economic indicator and go, let's look at this data and let's understand if it's accelerating or decelerating. And do we want to add more risk to a portfolio or decrease risk to a portfolio? And you run a back test, it looks great. You can do a lot of these things and you avoid certain periods of time, but that's a dangerous expectation, I think, to set. It's more about what's the behavior of this concept in different periods, and can you help frame some, goals for a model based upon what it's done. So I think the evidence-based investing concept, I think, is a good sales tactic, candidly, from our position, and then even more so from an advisor to their client, is showing that there is some process to what they've done. They're showing that it's not emotional, that they're going to follow these rules. They're going to modify the rules as needed. All of these, bullet points that go along with evidence-based investing. So there's that component to it, but I think it's better than doing the latter. And that is just, counting on someone's reputation or their opinion to make decisions for your model. I think actually showing somebody the evidence to why you made a decision that you made. And if you're wrong or right, at least you made it for a reason instead of, an uneducated guess.
Yeah, I mean, that's always the postmortem we have with the portfolio management staff here at DoubleLine, is that, okay, what'd you get right, what'd you get wrong? But, one of the early things that want to occur is write stuff down, like why you made a decision, why did you do this trade? And I think that postmortem can be helpful, and sometimes you can codify it in a set of rules, right? This is what I was trying to achieve. And then it always reminds me of Sam, when we hired one of our analysts on our team, and was teaching them kind of the rules of the road, and they were doing some back testing. He's like, I found this perfect model. If you buy equities every time the VIX spikes above 50, you make money. And he just wasn't looking at the time series. It's like, yeah, that was like in 2008 and 9, right? And so there was this, it was taking the idea and codifying it, but prior to that, the VIX had never been above 50, right? Yep. So that rule would have never been triggered, in your own mind. So I think it is important. And, you said taking the emotions out of it, which is very important, because, back tests are great, but you have to live through them, and your clients have to. So how do you kind of help bring that emotion out of it? That's one thing you're talking about here. How do you get people to stay tried and true to staying on the path?
I think it's not as easy on the front end. Like, I love the analogy you described. And, I've seen so many models built that have these 2-3 event periods that make their whole return. And you tell somebody, like, do you trust a baseball player that's 3 for 3, or one that's hit, 45,000 hits and 90,000 at bats? The data's worse on the second guy, but I would take that baseball player. So you want to have this kind of repetitive, multiple time periods tested across various countries if you can. So, trying to take that emotion out of that decision-making process is very important. I think I'm blanking on the first part of your question there, but
I'll come back to it. Just reminded me of a paper I also had said analysts read, was using the James Stein estimator, which, again, now we're getting pretty wonky. But what it does is it doesn't just take the outliers in it. It combines the averages of everyone. So it was a way of looking at baseball players too. And like, you have your Ted Williams, they hit 400 and the likes too. But is that repeatable and predictable? And it's a better way of kind of allocating across resources and things. So for our quant friends out there, which I think they're few and far between, look up the James Stein estimator and applying it to baseball. But back to the question, Joe, it's just taking the emotion out of it. How does one do so? And in a because again, you're evidence based. So how do you get rid of that emotional feeling that we all get from investing?
Yeah, I remember the question. I think it's more difficult on the front end because I've seen so many people take this concept and I think be a little reckless with it. And that is build a strategy, great back test. They sell the hell out of it, but then it ultimately disappoints because the expectations are set so high. That's where I think what we're doing, we're not trying to blow people out of the water with returns. It's more.
You say that real quick. I want to cut you off because someone taught me early in my career too, if you have a process, and again, this comes to be a lot of simulation, but if you have a process that generates, I don't know, call it a 4% return, right? And it has set amount of volatility around it. Well, and you say it has a 4% return, it has a 4% return, but during certain periods, you'll get 6, some periods you'll get 2, it'll average to 4, and all that stuff. If you're marketing and selling a strategy and you look at the long-term performance, you put a trend line around it, what you'll find is that people buy it when it's had the above average for that process, and they'll sell it below average, even though they intrinsically know that process. Mm-hmm. And so there is this emotional component. And I've applied that to kind of quantitative modeling at times to think about, okay, where are we in a cycle of these ideas? And so this is where that naive extrapolation gets you in trouble. But I just thought that's a very good point to talk about there too, inside of that.
Well, same thing. When I was at that Tamp, you have a lot of managers, I'm not going to name names, but had a fantastic 2008. Money just flowed into those strategies. And they ultimately disappointed. Some of them in one quarter underperformed by 20%. And if you would have experienced the whole thing, you'd take it. Right. Exactly like you said, they're buying in at the wrong time. So you're kind of chasing the hot strategy. We see it in the Tamp world. We see it in the mutual fund world. We see it everywhere. So that's my goal now. And kind of what I was saying is not sell the stuff that's worked, sell the process, sell the experience, sell the relationship, and sell the platform is what I'm trying to do. And that is, not just find 2 or 3 things that are working right now, but try to find things that are pretty durable in various market environments, dig at advisors, have them understand, and avoid or trying to keep them from making that mistake. Not only have the model be unemotional, but the advisor themselves be unemotional and remind them what they want in their portfolios and continue to show them if they're doing what they expected them to do and kind of keep them on the rails. So I think those are great examples and perfect to kind of what we're trying to do. And it's built a little bit on my historical frustration on working with advisors through my last roles. And if we can get them to live in the reality and truth and understand that, active management's difficult and say these things and not just put ourselves out there as building the next best mousetrap, I think it creates a better relationship.
Well, I know your quantitative background, so we got to drop some James Stein estimators when you're talking about shrinking your variance estimators. So, we got to do it every once in a while because I know Sam loves it when I nerd out like that.
Yeah, I'd be lying if I knew what you were talking about, but
okay. Well, you'll Google it and you'll see it's very simple. I made it sound way more complex than it is. That's what I'm good at as well.
Yeah, I smile and nod when those things happen.
Joe, let's wind it down, I guess, with some market thoughts right here. And just want to pick your brain on your current thinking about where we stand. We're winding down the third quarter of 2023 here. The S&P 500 is kind of like in the high teens type of year-to-date return. The ag is, I think it's still positive through today, but just hanging on there to a slightly positive number. And then when I look at the commodity market, it's got a negative print in front. So just across these asset classes, just how are you thinking about them? What's your outlook? How do you think clients should just be, investors should just be positioned as a whole moving forward in some of this uncertain world that we're at? And we've got a FOMC meeting coming up. With that FOMC meeting, it's a quarterly one, so we're going to have the summary of economic projections, which gives some insight about what the Fed's thinking about. We've got a fairly strong labor market, although we're seeing some deterioration in some of the metrics there. Inflation, it's still the problem for at least what Jay Powell most recently signaled. Just the process has got to go on a little bit longer, is what he said, I think, in terms of monetary policy. So just wanted to pick your brain, see what you're thinking, and some of your thoughts around that.
I think we've been treading water in this story for quite some time. I think, I look at the forward Fed interest rate projections. It's pretty flat. Maybe half a point is projected in the next meet, and that's not real. Like I don't see a full point in the data coming out, but that's been wrong. Like that story's been wrong for most of this year. And, valuations are pretty extended. The yield curve is still severely inverted. This recession that's looming has still yet to come. I feel the same now really that I did at the start of the year, but the markets continue to churn up as we've done it. So, I'm pretty steady as you go. I think forward valuation of the S&P is like 18, which is 18 and change, which is about historically average, if not a little bit more. I think, the Fed's done a good job of putting itself in a position where if data does start to get pretty gnarly, they can reverse course. And I think that's what's kind of priced in and embedded right now, is the fact that people are expecting economic weakness. They're in turn are expecting the Fed to react and, loosen monetary policy. And that's really given us a good buffer, I think, to the downside. So rather than just go sideways, we've actually churned up a little bit, more so in the tech. So from a quant perspective, I think if this were to continue to hold true, I'd like a little bit of a mean reversion right now. And that is value really catching up, maybe providing that, leadership here between now and the end of the year relative to growth. I think growth could use a little bit of a reset. We've had 7 companies in the S&P drive most of the return so far this year. So I think that's really concentrated on the growth, primarily tech side. Fixed income tend to be short duration still, just from an academic perspective of I'm getting a greater yield with lesser expected volatility than on the longer end of the curve. I'm not as insulated if rates do fall, and I kind of get that extended upside. But I like that kind of conservative approach. Take that 4.5–5% on the fixed income side of the book, go value. This trade's been incredibly long year to date. And I think a lot of quant-based models that are looking at a bad economic situation and are looking at, the valuation discrepancies between these asset classes have been completely wrong. So that's where I like to look at them even harder and understand if this is that period of time where there could be winners within those trades.
So where is the bad economic data? It's something we always debate. We talk about yield curves, LEI, stuff like that. But where is the bad economic data today?
It's not many places. I think a lot of sentiment, and it's a lot of, it's projections. A cool chart we put together was looking at the Conference Board leading economic indicators versus the coincident, which is that concept, right? So it's like 8 leading economic indicators versus 4 that are happening right now. And there's been a massive divergence. It's been positive on the coincident indicators and negative on the leading. So I think there's just this expectation of bad that's supposed to be happening, yet the data continues to be good. So, I know it's a massive overgeneralization, but it hasn't hit the consumer. It hasn't hit employment. It hasn't hit a lot of these things that get really nasty around recessionary environments. And that's where I think the story of a recession right now, I don't really care if it's true because I don't know how they're going to define it. And if they do define it, what does it really look like for the market? I think the bad component of any near-term recession happened in 2022. That's where we saw the volatility. That's where we saw rates spike. That's where we saw, equity markets fall. That if we hit a recession right now, I don't know if it's a bad thing for equities. I just don't. And you go to the recessions prior to the past 3 that we've had, 2008, tech bubble, from start to finish of recession has been, I think the 3 prior to that have been positive for equity markets. So it's just not in near-term memory, but it's not unprecedented to have this market right now where we can get deteriorating economic data, even though it's not bad. But if it does get bad, like many people are expecting it through sentiment, it might not be that bad for assets.
Yeah. I think it all comes down to the Fed's reaction function, because I think, as you mentioned, there is this belief that, I'll use your quote, if the data get gnarly, the Fed can react, right? and they can cut. And I think there's some of that is baked in there. And I think that I believe in that. My only concern is that what happens if that happens, the data get gnarly whilst, as Lau likes to say, we have inflation, right? And does the Fed still have that fortitude to cut? And so, again, I'm not saying those things work together, but I do find it very interesting that we went through a period for the last few weeks where when we got bad news, it was good news for markets, right? And those always kind of scratch your head a little bit. But I think what you said was very important there because it was sentiment. And sentiment's been negative and it outperformed sentiment. And so all of a sudden you get kind of the FOMO trade, right? It's the something happens and it swings in the opposite of what you think. And so I still think that, with the Fed needing to stay tight, they will stay tight. I don't buy into the forward curve estimate. I'll clear the air here on the podcast. I did not say that the Fed is cutting 100 basis points because a recession's imminent. I said I could see potentially, if we have a recession, the first cut from the Fed's not 25. It's 50 or 75. And it could be as much as 100. And they got blown out of the water, and everybody called us and said, "Why are you so crazy?" But crazy is a good thing, I guess, at times too. But
when's that point when they declare it a recession? When does the flag drop?
Yeah, exactly. And look, the NBER who declares the recessions declared we had a recession in March of 2020, and it ended in April of 2020, by the way. And they told us that, what was it, like July of 21, Lau, something like that? It was definitely the summer, right?
Yeah, it's definitely lag.
Yeah. Right. So it was a little bit of a lag, but also, I think this is the thing too, just because we didn't see anything negative happen doesn't mean it won't happen. And that sounds very obvious. But what I mean by that is that there's just been so much of this policy that hasn't trickled to the economy yet. It hasn't reset the housing market. It hasn't reset a lot of corporate America. Banks still aren't paying market rates. Janet gives you a higher rate than you can get at the bank, right? And so the transmission mechanism, it's not broken. It's just trying to operate the lag because banks are trying to save face. They want positive carry. They can't lend you money. They can't give you deposits and give you interest at 5.5% and make loans at 4%. It's just not profitable, right? And so, I think time is the enemy of this thesis. But right now, like we've been in kind of this Goldilocks world, and being in Goldilocks, enjoy it. That's why stocks have went up, right? That's why credit has done well. And, that's what we try to profess to our teams too. You don't have to have every trade right. You got to have it right in aggregate, right? And that's why we need disparate views to go through this. So, you mentioned like the simple model today. The simple model being domestic, international, you said bonds and commodities, right? What does that look like today in kind of your tactical asset allocation model? If you're just kind of allocating capital, thinking about valuation, thinking about risk management, how do you allocate across those 4 things? Because Sam said he wanted to reallocate his portfolio today, so we're trying to get him some free asset allocation advice.
It's tough to answer that because, I go back to that. I don't want to make that call. I have a way of looking at that mix right now that would be, relative strength related.
Okay.
And would continue to position me in U.S. equities over international, over bonds, and over commodities.
Yeah.
And really kind of like taking that flow. And that's kind of completely counterintuitive to what I said before. But that's what that piece of data is telling me. But I can switch on that, right? I can look at that signal and make a change, weekly if we need to. That being said, I think we're back to what was damaged in 2022, and that is a good diversified portfolio makes a lot of sense, where, mid-duration fixed income, some equities, maybe keeping that international, more in line with global market cap, like at a 40%, 45% weight, is, from a forward-looking perspective, more valuable than it was 2 years ago. Yeah. And when you weren't getting anything on fixed income, that was a really tough thing to do. So that's where you look back at like the Bridgewater all-weather asset mix of projecting for inflation and growth expectations to do well or disappoint and kind of hold that core portfolio. I think it's an attractive portfolio again, especially the fixed income side of it.
You're speaking to our hearts, dear to our hearts there, Joe. So with that, let's not have you start bad mouthing bonds, and let's end on the high note for Sam. And hopefully you took heed on that asset allocation advice. And before we let you go, though, what we have to do is introduce you to Sam's favorite part of the show. So Sam.
All right.
All right, Joe. My favorite part of the show is often the hated part of the show for the guests. So it's Sherman Says. It's where I will offer a series of alternating prompts between Sherman and yourself, Sherman and you, and to listen to the top of mind response there. So I'm going to kick it off to Sherman first to provide an example. Sherman, you got student loan payments.
Yeah, I was going to say, Sam, when he looked at that, he knows the reflexive parts really cause me consternation here, and people abuse them. And so the yourself, myself is overutilized and actually used inappropriately most of the time. That said, student loan payments, have fun. They're back. They're in vogue. Pay Uncle Sam back. You owe him money for the last 40 months.
Yeah, I think as I heard you say earlier today too, summer vacation's over, school's back in session. So I guess the debt repayments are as well. So
do I get that?
I did
one
say
too?
that, and I said that also means now we got to pay the bills too, and that includes Uncle Sam here too. By the way, we are hypocrites because in California we haven't made our federal tax payments for the year yet, for last year or for the quarters because of the flood relief we got from January when we had our storms. So for all those people worried about federal tax receipts being diminished meaningfully, don't worry. October 15th, some people will be helping stuff those coffers. So
yeah, it'll be a deluge of pain. All right, over to you, Joe, with reinvestment risk.
Oh, it's important again. It wasn't for the longest time, but I think that concept of why not just own something that gives you 5% risk-free versus taking duration risk and owning something that has 4% with duration risk. Why would you do it? I think that's my number one answer. You ain't going to get that 5 once it rolls off, and you got to reinvest it. So inverted yield curve and higher level of rates, bring that topic back into the conversation. I think anyone that finished college in the past 10 years doesn't even really know about that term.
I would say it's one of the most underappreciated risks and dear to a bond manager's heart, just in general. And that's the yield to maturity assumption and things, is that reinvestment. So a very underappreciated risk. But for those that have played the game, I say, I'm okay with you playing it for a few more months because I don't think the Fed does anything. But guess what? The market's going to get ahead of you in terms of timing. So you got to be smarter than we are to be able to get that timing right. But I appreciate that concept, Joe.
Mm-hmm. I said that to a lot of people. If you took the drawdown in 2022, and you're going to sit in cash on the way up, you're not going to be happy. Yeah. And bonds are very mechanic, not like stocks, and that's going to be that's entirely a possibility. And I think a lot of people could get burned by where they're positioned right now.
All right. Sherman, over to you with crude oil. We were talking about my swimming pool before. What's your thought on crude oil?
Well, it's been about $150 swing since you tried to fill your swimming pool up, right? From the negative prices, I guess 140 or so. I don't know. Crude oil seems a bit rich today to where I'm thinking right now, just given, again, thinking about the construct of the demand situation, seeing all the headlines coming out of China, just the fact that the reopening story didn't play out there. Driving season's over. We've got to pay the bills again. You've heard me lamenting all week about petrol prices, Sam, continuing to go up. I didn't tell everyone. I didn't buy gas all week. I watched it go up, and it went down 10 cents this morning. I went in and swooped in and got it. So I felt like I was a value investor, Joe, versus the growth investor there, albeit it was higher than where it started the week. But you can't see how there's a 10 cent swing down in one day. So maybe they were a little too usury. So,
all right, back to you, Joe, with investor sentiment.
Oh, not that valuable anymore. And we've seen it where coming from my seat as using it as an indicator, we have investor sentiment. We also have news sentiment. And we also have just, consumer sentiment. And I've tested all of those. Really great indicator up till 2020. Horrific in 2020. When people feel horrible and the market rallies because of stimulus, that is a perfect storm for relying on investor sentiment. So I think, like many things of 2020, we're nearing the end of the ripple effect of how it was so nasty that we might be settling back to a point where it's important again. But when you go to this extreme difference of markets disassociated with sentiment, it's going to take time for that to really figure itself out. So
I was going to say, whatever happened to the meme stock craze, too, and everything, too. It played out a lot longer than most of us thought. But I was also kind of positing the idea on the desk that maybe the meme stock craze went away because now they charge for Twitter. And I know that we all just stopped using it because I don't see the value of $9 to have people just yell at me all day long. I get that for free at work. So
so many things happened in that year period, though, where I don't know if I just blacked out for a year, but you start to remember these things like, supply chains and not being able to get any. I remember buying furniture, not getting it for months, and it's just like so much crazy stuff happened in that period that you forget some of these major events that just kind of are less important than.
Yeah, I had a washing machine error, LE, and could not figure it out. I was trying to restart it and everything. Said, well, maybe I'll get another one. I wonder how long it'll take. It's like a month or two. I can have it in 3 days, delivered, installed, and everything. And so I definitely hit the bid on that. So I think it has the world has kind of reverted back to what we recall it being prior to 2020.
Mm-hmm.
Yeah, I guess we just all realized we took a lot of stuff for granted, prior to that period. So
I know.
Definitely. So Sherman, let's see, where are we at here? Let's go with Chinese economy. Or broaden it out. Let's go China. There's so many things going on.
Yeah, I mean, it's a big country. The economy, I have no idea what's going on there. Any data that seems to be negative gets discontinued its time series. That's been the trend as of late. I think we're gonna test this new thesis, and I think you've heard me say it, Sam, where the old saying was, when the U.S. sneezes, the world catches a cold. And I've always asked the question in this last cycle of China's growth: what happens if China sneezes? Will the world catch the cold? And so far, we've been immune, and that's not a COVID joke, Sam, or anything in there. But like the thing is that I think we've been immune this far, and that's every like punditry has been so absolutely wrong this year, right? And all these trades are all what was going to play out. And so I think the question becomes, maybe the Chinese slowdown coincides with the U.S. slowdown, and we don't get to fully test that thesis, right? Because we have the composition error. But I do think that as you think through it, I don't see how it's easy for the world to really thrive if the Chinese have a recession. And so again, it feels like maybe we get the perfect storm together on this, but they've got a big overhang. To me, it feels like their property sector looks like kind of like the Japanese property bubbles from the 80s and the like, overbuilt, not utilized, valuations insane. And so I just don't know how to get a good read on it. So long-winded would say that we're not invested in China. I'm happy to abstain at this point. I know we'll get some flack for that in the feedback, but in general, just to me, coming back to Joe's evidence-based world, just the data is not reliable or analyzable to me at this stage.
I think, their whole trend of nationalization and just, exports decreasing, imports decreasing. There are, globally a huge buyer of goods, and they're a source of cheap goods. And if both of those things are breaking down, which the data suggests, I don't think it's good for the global economy. They don't care. And today, what was it this morning? They said, Chinese officials can no longer have iPhones on property.
Yeah, government officials. Yeah.
So China represents what I think 20% of Apple's total sales, the number 2 country behind the US. And if that is, a hint of something larger in terms of what they want to shut down as far as US good usage, it could be pretty bad.
And that's the reason it's taken out $250 billion of market cap out of Apple this week too, right? So it's had its impact on the market cap too. So no, I agree with that too.
Joe, here's a question I wanted to ask in the regular segment, but I forgot. And you brought it up. And the reason I wanted to ask this because you brought it up in the beginning. AI as an investment tool?
I can speak to how we're using it heavily. A comment I often get is, Joe, if you guys are trying to build custom investment models for hundreds of advisors, are you going to end up with tens of thousands of different iterative models? The answer is hopefully yes. So how can we leverage AI to draft trade rationale or commentary for each of these specific models? And what we can do, we can train it to what the rest of, or what the ingredients are of the model. It can figure out the math at a high rate to spit out the other end. Same thing on a front end commentary of, what does this model do? Well, I know it has A, B, C, and D. Therefore, here's the narrative with your title on it. So that's how we're leveraging a lot just for internal processes. It does a lot of what analyst work used to be. But as far as an investment vehicle, I think people are doing, there's so much going on, like overanalyzing things with machine learning and AI to find stock picks and launching funds based upon AI, stock picks and data. Like that's so above and beyond anything I can grasp. And I don't know if it'll work. But I think you're not going to see the end of it. I just think the next few years, AI is going to be a topic of conversation in all of its uses.
All right, you're in the vanguard in terms of the usage here for an investment advisory business. Let's see here, Sherman, services economy.
Crushing it. Look at that number that we got out of the isms this week, right? I mean, look, it's also August. It's the last hurrah, the last party. But man, services is a resilience. This portends well for what's been going on from the consumer, from just experiences. I think a lot of it is just the jobs remaining relatively stable and wage growth being there. And so people are out there spending money, and that's what makes the economy go around. And so this idea of a recession, we have to see services slow in order to do so. And everything about that report was extremely positive, at least backward looking for the month of August. It was very positive.
Didn't even see much commentary from the perma bears out, after that report,
maybe services prices paid, because again, it was up a little bit. I mean, that's where you can start to hate. It's going to have some, but look, this is, we did a internal podcast or a Channel 11 show. It's with one of our portfolio managers. And we just call it the haters ball as a homage to Dave Chappelle and, what they had done there. And I mean, it was just like, man, the haters are just loving life, man, because that's what's happened on everything. It's been the opposite of everything. So, but again, I think you should expect that at this point, during the summer months. And we'll see when we come back. And, again, there's more burdensome payments and the like. But I don't expect this economy to fall off a cliff. I think, we're going to slow, and then we're going to see, and when the rubber meets the road, as we get deeper into the fourth quarter.
All right. Commercial real estate, Joe.
I would say I'm still pretty bearish over it. And here I sit in an office building just outside of downtown Minneapolis, which has really yet to recover. You still see a ton of vacancy in the downtown area. I'm kind of in the, up and coming cousin neighborhood of downtown Minneapolis, and it's pretty thriving here. It was tough to get office space. So
come to downtown Los Angeles. You'll see some vacancy. You can set up shop here. Mm-hmm. I know Brookfield will lease you some property pretty cheap these days.
Mm-hmm. I think it'll come back. Like, I mean, it's not my forte, but it seems to come back. And you look at places like New York, and what I'm hearing there is, it's getting back, especially the prices for office space and, apartments and all those things recovered pretty quickly. That I think some smaller cities like Minneapolis will take more time, but it will come back. I'm not bullish on the asset class because I still think it's going to be tough. We've evolved to a more work from home environment, and it's going to take time to really revert that, but it'll happen.
Yeah. We'll and you can't cast a wide net, I mean, there's so much idiosyncrasies about it. Sorry, Sam.
No, I was going to say, we'll see how the Minneapolis winters fare. See how work from office and work from home fares when the Minneapolis winters hit and people have to
I'm in 5 days a week now. I can tell you in February, I'll be lucky if it's 1 or 2. So
That's right.
You're not going to be going to the hamster little area, right? Those little
the Skyway system. No.
Yeah.
All
I've
right,
only been there once, and it was cold. Yeah. So anyway, go ahead, Sam.
All right, let's round it out here. Last question for each of you. Sherman's, yours is Brock Purdy versus Sam Darnold.
Man, that's a battle for the ages. Who doesn't want to watch that this weekend, right? Look, I think Darnold, he's a decent quarterback. He just had the pity of having to play for the Jets, so we know what that does to most people's career. And you're a former Aaron Rodgers guy, so I know you're gloating watching him go to the Jets and how in that big mainstream media they're going to eat him alive when he turns into Aaron Rodgers and his I totally pivoted this too. But the Aaron Rodgers component is that he's great while he's winning. When they start losing or something bad happens, he's going to blow up and that media is going to eat him alive. And he does not thrive well in that situation, just like playing the Niners in playoffs where he's 0-4 in his career. Okay. That said, I'm a Purdy fan. I still think he is the number one right now. I'm not mad at Darnold being there. I'm glad we moved on from Trey Lance. That's what you learn in portfolio management. The first loss is your best loss. Move on. And we just signed Bosa. It's going to be tough this week. Steelers, playing Steelers on the road, don't love it. But I think the Niners got a good shot this year. So I'll ride the Brock Purdy bandwagon. And Darnold looked good in training camp. So I'm riding Purdy is where I'm going with that. So long-winded way and had to bring some Jets hate for our fellow colleague Kimbrough. So there you go.
Thanks for bringing the Aaron Rodgers hate too. So
yeah.
All right, close us out here, Joe. I'm going to give you Golden Gophers.
Ooh. Oh, you hit me right where my passion is. Wow. I was at the game last week. It was a nail biter. Haven't had a good football program in a long time, but I think we're on the way up. Our basketball team is horrible, but I'm a diehard fan. I'll be at the game when they visit North Carolina. They have a tough schedule. Our rivals of Wisconsin and Iowa have pretty easy schedules. We get both Ohio State and Michigan, which in those crossovers is tough. I think last year was our window, but I'm still a diehard fan and overly optimistic whenever I get asked that question. So we're going.
Joe, Sam's a Badger. Sam's a Badger, so you got to watch out. That's
really,
yeah,
yeah. I'm sorry.
That's all right. It's all right.
I taught my 5-year-old that Bucky is yucky, and so
I love it. Well, look, this is a great thing about sports. They bring us together, they tear us apart, but it gives us something to do when we're not thinking about markets. So, Joe, really appreciate the time today. Before we let you go, though, real quick, can you tell our listeners, too, how they can get in touch with you, get more information on Modelist? Give us your 30-second commercial.
Yeah, great. If you want to find out more, website's modelist.me, M-E, or hello@modelist.me. You can always get me directly at joe.mallen@modelist.me. I'm not super active on Twitter, but I do have an account and I like to tweet things that other people say. So if that's worth anything, but yeah, feel free to check it out. If you have interest, let me know. And, excited for the future here.
All right. Well, congratulations, Joe. Last time I saw you, you did not have Modelist founded yet. So we're very happy for you. We wish you the best of success out there. If you ever need any help with working on some of those models, I know a couple guys around here that could maybe help you out. So thanks again. We really appreciate it. Thanks, everybody, all of our listeners. We're back after our summer hiatus. We took August off. We're going to be grinding through a few of these podcasts for the next couple months. Hopefully you find them as entertaining. And we know that Joe Mallen set the bar very high for our future guests. So thanks again, Joe.
Appreciate the time, guys. Thank you.
All right. Take care.